All right, welcome to our latest video on Chapter 5. We're going to pick up our discussion about risk and risk premiums here. First of all, you're aware that the risk-free rate is the rate on Treasury bills. The risk premium is the amount an investment earns above that risk-free rate. Because we can earn this risk-free rate taking no risk, right? We can just buy Treasury bills that have no risk. We need an excess premium above that amount in order to take the risk of an investment other than T-bills, and that is called the risk premium. And for the stock market, like the S&P 500, that would be called the market risk premium. The amount that the market returns less the risk-free rate is the market risk premium. Now here it's excess return. Excess return is the more historical rate of return in excess of the risk-free. The risk premium is the expected return above that on risk-free returns or securities. Risk aversion, you need to know that term. That is that a normal investor does not hope to accept risk, right? So we want to be rewarded to accept risk. We want to be rewarded with a greater return or expected return. And we can say that there is a price that we would be willing to earn for accepting risk. And it's the ratio of the risk premium to the variance. And we're going to talk about that more in just a second. That's known as the Sharpe ratio, the reward to volatility. So volatility is our measure of risk. So we would like to know with certainty what our return is going to be on an investment, but risky investments, that is not for certain. Those returns are not for certain. And we measure volatility with standard deviation. That's our measure of risk. So the Sharpe ratio compares their expected return, the reward, to the standard deviation to give us a ratio that measures the return for a unit of risk. And it's calculated by taking the risk premium, not the total return, expected return on an investment, but the risk premium divided by that investment standard deviation to give us a Sharpe ratio. And the higher the Sharpe ratio, the more reward or return we're getting for each unit of risk as measured by standard deviation. By the way, it is a common measure of an investment, the reward per unit of risk, right? We can see here a table of excess returns for the market, the overall stock market, broken down into different periods of history. So we have the average return for 1926 to 27. Here was the standard deviation. So we would take this average return, actually I believe this is the excess return over the risk-free, divided by the standard deviation, gives us a Sharpe ratio of 0.42 for that time period. And I just verified my calculator, 8.48 divided by the standard deviation of 2.29 does equal a Sharpe ratio of 0.42. So this is the excess return over the risk-free, this column here. And then you can see the Sharpe ratios through history, different time periods, to give you an idea of what a normal Sharpe ratio might be. And this is now for the market index, so that's a very diversified portfolio. We would expect lower standard deviations for more diversified portfolios. By the way, the Sharpe ratio is a valid statistic only for ranking portfolios. It's not appropriate, does not work well for comparing individual assets. So keep that in mind. Here we have a list of two government issues, T-bills and T-bonds, and stocks. And you can see T-bills, our risk-free asset, has a fairly low, pretty low arithmetic average. This is over a long time period here, 1927 to 2016. Stocks have the highest arithmetic return and also the highest of the three standard deviations. So there's more volatility here, more erratic movement, which means there's more risk. By definition, higher standard deviation, higher risk. This, by the way, standard deviations in the stock market is ran as high as 56%, as low as negative 43 on the negative side of the curve. And you can see much lower statistics here, standard deviations for T-bonds and T-bills. A graph also illustrates the very narrow range of variance, low amount of variance between returns from year to year or period to period returns in Treasury bills. When we move to bonds, you see a greater spread of returns or greater variance. And on equities, much broader variance in returns, which, as you know, take the square root of variance and you'd get standard deviation. So you can see why equities have a higher standard deviation versus bonds or bills. John Bogle, the former chairman of Vanguard, is known for saying the most fundamental decision an investor can make is how to allocate your assets. That is, how much should be in bonds versus stocks versus derivatives. And he pointed out that 94% of the differences in total returns among institutionally managed pension funds, these are professionals, was accounted for by asset allocation. And he thinks the same asset allocation decision is what's going to drive individual returns for individuals as well. And of course, asset allocation is going to drive how you allocate your capital between risky, which means stock market type assets, and bonds versus risk-free assets like Treasury bills. And you combine the risky assets with the risk-free, and that develops the complete portfolio. That's how we build a complete portfolio. So, as I mentioned, the risk-free asset is traditionally known as the T-bill. However, we can stretch that a little bit, as they do on this slide, to assets that have very little risk. Treasury bonds are issues of the federal government with maturities at 10 or more years away, 10, 20, 30 years. The problem with those, we do not have default risk because the United States can increase taxes. They have taxing power, so we don't have to worry about the government defaulting. But there is, over those longer time periods, more significant inflation that erodes the real return of those bonds. So they're not completely risk-free. Now there are government bonds called TIPS that are Treasury Inflation Protected Securities. TIPS, T-I-P-S. And those then guard against inflation. The price of the bond, the principal that'll be paid back, is stepped up with Consumer Price Index, CPI, which is our proxy for inflation. And you need to know that. So we could say that TIPS really are a risk-free asset. I can go along with that. Money market instruments are effectively risk-free because the government now has the pattern of stepping in times of financial meltdown if money market accounts get in trouble. The risk of CDs and commercial paper, pretty small, still not completely risk-free, but anyway, that gives us some variety of some investments we can make that are risk-free or nearly risk-free. So this slide gives you the nomenclature for the following slide that looks a little intimidating at first, but it's not that bad when you understand it. This capital allocation line, this blue line here, is also known as the security market line. And that is part of, if you've had Finance 302 or Financial Management 2, you've studied the capital asset pricing model. And that security market line is the graphical representation of this model. And in this instance, it's called the capital allocation line, which is really just another term for the same thing. And here's what it is. So this is how we allocate our capital, right? We can go 100% into the risk-free investment, let's call it treasury bills. And treasury bills, since they're risk-free, have a standard deviation of 0, okay? Because we theoretically call T-bills risk-free. So the risk-free rate in this example is 7%. You can earn 7% taking no risk. And as we move out the x-axis here, we take more and more risk in the form of standard deviation of our portfolio until we get to the market portfolio right here, which is the stock market, and they're terming it P portfolio, has an average standard deviation of 22% right here. And the expected return on the market portfolio is 15%. So if you put all your money in an index fund that owned the S&P 500, in this example, you would expect to return, this is expected, the E here, expect to return on that portfolio 15% at a 22% standard deviation. Now this 15% return is made up of the risk-free component is 7% of the 15. And if we take 15 minus 7, we get 8. And the market risk premium here is 8%. We can divide the 8 by the standard deviation here to get our Sharpe ratio of 8 divided by 22, whatever that is. That would be the the Sharpe ratio for this market portfolio. So, and here in fact is the market, this is the expression for the market risk premium. Expected return of the portfolio, the market portfolio minus the risk-free equals 8%. That is our market risk premium I talked about earlier. Okay, so there's more detail about slides, including this one at the end, near the end of this slide deck. If you go to the PowerPoints, you'll be able to look at that and get a little more detail on that. But this capital allocation line or security market line gives us the entire investment opportunity set. Here is our market portfolio, but we can use a margin account and leverage to create an account that holds more than the amount of funds we actually have, so that we can then create a portfolio using margin that's even further out the standard deviation, because it'll be more volatile using leverage. Leverage creates more volatility, as we saw earlier. So anyway, this is just a graphical representation of all possible combinations from a portfolio that's totally risk-free in here, and we can layer on all the risk we want and to the limits of the amount of money we can borrow. And then find, as you can see, if we had enough lifetimes, we should average out on a diversified portfolio any point along this blue line. We get way out here, it's going to be more volatile, and we would get a higher return in exchange for accepting more volatility. Now that you understand the capital allocation line or the capital market line, you can see how you could use a passive strategy, one that seeks to decide where do you want to be on that capital market line, and use index funds that are passively managed, do not have a manager trying to pick winning stocks, but rather decide how much of your capital you wish to have in the stock market and buy S&P 500 index fund or some other, or using index funds that just track a particular sector or overall broad market. You could track the NASDAQ or the New York Stock Exchange or international stocks, rather than trying to pick winning individual stocks, which is a very dicey business. research is not on the side, is not glowing for that professional investors can outperform these index funds. And we'll be looking at that more in some detail. And now that you are familiar with this capital allocation line, you can decide how much standard deviation you're willing to take and invest. If you're willing to take 22% standard deviation, and you can go back to that normal distribution curve and see what your 3 standard deviation on the negative side of the curve, what kind of loss that would create. If that's too much for you, then back it off to 1 standard deviation or wherever you want to be, and find and then calculate what percentage of your funds you want to have in the market so that you can exceed this risk-free rate. Now this is an old chart. The risk-free rate now is down below 1 or 2%, but we can use the current risk-free rate and the expected. You can Google expected. I believe you can Google expected capital market assumptions. I believe BlackRock, one of the largest investment companies in the world, publishes their capital market expectation, and that's what they're expecting the market to return over the future. And then you can use that information to decide how much of your funds you want to have in the S&P 500 fund, and how much to keep in risk-free assets. So the reason I'm a proponent of passive investing, as is our textbook, is that you can do it inexpensively. It's very simple, and they're very inexpensive, low cost. Active managers, when you hire a manager, you can expect to pay 1% or more for their expense ratio. And that has a huge impact on your returns over a long period of time. In fact, 1% extra expense, that of course reduces your overall return by 1%, over a 30-year time horizon, in 30 years, you would earn about 1/4 less. Your final wealth at the end of 30 years would be about 25% less with the addition of a 1% fee. So you want to really keep an eye on these fees and keep them minimal. And we'll be talking about that more as we go along, about passive investing, using mutual funds and exchange traded funds to lower your expenses. So we're going to conclude our last video here on chapter 5 right now. I encourage you to read the book. There'll be test questions that are not in the book. The homework is going to help you use the helps in the homework to explore the textbook, and that'll help you as well. So, the things that we have to, since picking individual securities is very difficult, the fact that professionals have a hard time outperforming the market average, we need to focus on the things we can control. And one of those is you can control how much money you can save. That's why I continually encourage you every video to save money, spend less than you earn. And the other thing that I pointed out in this slide is you can control the expenses you incur in your investing. So focus on what you for sure can control. And because the things we can't get a lot more challenging, don't they? So anyway, I will see you in the next video.